Hi, I'm Kathy. In this video, I'll be describing tax deductions and tax credits because they represent a valuable tool that can help the taxpayer, that's you, minimize your tax liability, and that's what you owe. That way you can retain more of your hard-earned income. Stick around to the end to see if you can answer 3 questions about optimizing your tax returns and maximizing your potential savings. Tax time makes people feel all sorts of different ways. Some people think, yay, I get my money back. Others feel the dread of coming collection of documents, filing, and worrying if you did it right. Well, I have some tips that will hopefully make filing a little bit easier and maybe help save you some money. The first is the news that the IRS has launched a program called IRS Free File for the 2024 filing season, and that's the 2023 income that you report. With this program, eligible taxpayers can prepare and file their federal tax returns using free tax software from trusted IRS Free File partners. Taxpayers including active military with an adjusted gross income or AGI, and this is your income before taxes are taken out, which are your wages, dividends, capital gains, business and retirement income, as well as other kinds of income. For example, that might include tips, rent, interest, and stock dividends. Then after you take out all the deductions that are allowed, if your AGI is $79,000 or less, then you can likely find an offer from an IRS free file provider that matches your needs. Some of the providers actually offer free state tax preparation as well, and those with an AGI over the limit can still file their return for free using free file fillable forms. Don't say that many times. But they don't include the free state return options, and there's no guided assistance. To find the right IRS free file offer, you just need to go to the irs.gov and search for free file, and you'll get more details. Luckily, these providers are supported on smartphones and tablets, so you don't even have to have a computer to use them. Currently, there's about 10 different companies that offer this through the IRS. Now, tax credits and tax deductions change the amount of a person's tax bill or refund. And this is why you should understand which credits and deductions that you can claim and what records you're going to need to show your eligibility. So, what are tax credits? A tax credit reduces the income tax bill dollar for dollar. And that means that if you owe $1, they're going to give you $1 that a taxpayer owes based on your tax return. So if you owe $3,000 and you have an applicable tax credit, let's say of $1,000, now you owe $2,000. These are great for reducing your tax bill because a tax credit is an amount you subtract from the taxes that you owe, meaning you can lower your tax payment or increase your refund. Some credits are refundable, and that means they'll give you money back even if you don't owe any tax this year. An example of one of those taxes is the Earned Income Tax Credit, which is a refundable credit. And this means that your tax bill is less than the amount of a refundable credit. You're actually going to get the difference back in your refund. Other kinds of credits that might include are the Child Tax Credit, Child Independent Care Credit, Adoption Credit, Earned Income Credit, Savers Credit, Lifetime Learning Credit, and Electric Vehicle Tax Credit. Now, this is not a complete list, but if you'd like me to make a video on these, what they are, and what documents you need to prove that you can take the credit, then let me know in the comments below. So to be able to claim a tax credit, or even a deduction, I'll talk about that later, you'll need to keep your records to make sure you're showing that you're eligible for that tax credit. Deductions, on the other hand, can reduce your income before you calculate the tax that you owe. Most people take the standard deduction, and this is that flat rate deduction that everyone's eligible for. The amount might change based on your income a little bit, and it varies each year, increasing for inflation. But for your 2023 taxes, it's $13,850 for single or married filing separately, and $27,700 for married couples filing jointly, or $20,800 for head of household. The amount of your standard deduction depends on your filing status, your age, whether you're blind, and whether you can be claimed as a dependent by someone else on their taxes. This deduction then reduces your taxable income, meaning the amount that they calculate how much you're going to owe taxes on. There are deductions that you can take even if you're taking that standard deduction. That means that you take your standard deduction and then reduce it even more. Some of those basic deductions include business use of your car. If driving is part of your work need, you can deduct it. Alimony payments, these are payments that you've made to another person. Business use of your home, This one's kind of tricky, so make sure you're really confident before you take this one, or work with a professional to make sure what percent you can take. Money that you put into an IRA. Any funds that you put into your IRA this tax year is deductible, and that includes right now all the way up till tax filing time. Money that you put into your health savings account, so money you put into your HSA, also deductible. Student loan interest. If you paid interest on a student loan, you may be able to deduct that interest from your income. Teacher expenses. Now that's up to $300 of your classroom costs that you paid this past year by the taxpayer. For some military, government, and self-employed people and people with disabilities, you can receive a credit for work-related education expenses. And military service members also can take moving expenses that you use to relocate as a deduction. For those with deductible expenses that exceed the standard deduction, you can itemize your deduction. And this is because it reduces your taxable income even more than the standard deduction. If you're able to itemize your deductions, you're going to be allowed some of these expenses. Bad debts. Now, this generally refers to a bad debt where you have previously included the amount on your income or loaned out cash to someone. If you're a cash method taxpayer, and most of us are, you generally can't take a bad debt deduction for unpaid salaries, wages, rents, fees, interest, dividends, and similar items of taxable income. For bad debt, you must show that the time of the transaction that you intended to make a loan and not a gift to someone. So if you lend money to a relative or a friend with the understanding that they may not repay it, you have to consider it as a gift and not a loan. But if you expected to get paid back and they knew that, that's a bad debt. You can also claim canceled debt on your home. You can report the debt forgiven on your residence due to foreclosure, repossession, abandonment, or because of a loan modification or a short sale on that property. Donations to charity. For contributions of cash, check, or other monetary gifts, regardless of the amount, you must maintain a record of the contributions, and that can include a bank record or a written communication from that qualified organization, and that will contain the name of the organization, the amount, and the date of the contribution. You can deduct money earned from the sale of your home. If you meet certain conditions, you can actually exclude the first $25,000 of gain from the sale of your home in your income and avoid paying taxes on that. The exclusion is actually increased to $500,000 if you're married filing jointly as a couple. Deductions can also include gambling losses. You're going to need to contact the IRS and fill out a little form to see if you qualify, but you could deduct those possibly. Home mortgage interest. Deduct the amount that you paid in mortgage interest points, mortgage insurance premiums, and other mortgage-related expenses. And this is where most people exceed that standard deduction. Income, sales, real estate, and personal property taxes also may be deducted if you're an itemized deduction person. And state and local income taxes that are withheld from your wages during the year, and this will be on your W-2 form. Those estimated state and local taxes and prior year's state and local income taxes that are paid during the year can be deducted. Losses from disasters and theft. If you're an individual and there's a casualty or theft losses to personal use property, they are deductible only if the loss is attributed to a federally declared disaster like a flood or a hurricane. And finally, there's a medical and dental expenses deduction, but it has to be over 7.5% of your adjusted gross income, and this is a really high threshold to achieve. For example, if your AGI is $50,000, you'll have to paid over $3,750 in medical expenses for the year. Capital losses can be deducted if you have a capital gain and you sell the asset for more than your adjusted basis, if you have a capital loss and you sell the asset for less than your adjusted basis. Losses from the sale of your personal property, such as a home or car, are not tax deductible. All right. Are you ready for the 3 questions that you should be able to answer? What are tax deductions? How do they compare to tax credits? And what are you going to take? The standard deduction or itemize? This is Kathy. Thanks for allowing me to guide you on your journey to financial empowerment. Please let me know what topics you'd like covered in the comments. And if you're new here, go ahead and consider subscribing and hit the alert button so that you know when each new video comes out. That way you can improve the way that you think about your relationship with money.